Good evening, ladies and gentlemen, and a very warm welcome to you on India Tonight. Also wishing all our viewers of India Tonight and ET Now a very, very happy 2026. Happy New Year to you as well, Shibani. Shibani, my colleague, is joining us from our Mumbai studios, ladies and gentlemen. And tonight on the show, we put the spotlight on a very important story that we want to tell here on the channel. Well, India's Billionaire Club has become more exclusive in 2025. It shrunk from 204 members in 2024 to just about 176 members in 2025. Now think of it as a velvet rope party where fewer moguls made the cut this year. The collective net worth of India's ultra-rich also slipped by 5% to around $980 billion, and that really reflected the slowest pace of market cap growth in recent years, Chibani. But we understand that inside this club, fortunes actually danced wildly.
Absolutely, Sumita. In fact, inside the club, the fortunes danced wildly. As you said, several prominent billionaires saw their fortunes shrink noticeably. Cyrus Poonawalla, India's vaccine king, lost nearly $1.8 billion, while real estate veteran KP Singh took a sharper hit of almost 20%, reflecting the sector's slowdown. Together, these declines highlight how turbulence across healthcare, real estate, and consumer sectors weighed heavily on India's billionaire balance sheets. To discuss this and more, in fact, Sumita, today we are joined in by Sunil Subramanian, who's a market expert, and Sudeep Bandopadhyay, who is another market expert. Both of you gentlemen, welcome to ET Now. So good to have you on the show. And first, let me begin, this discussion by wishing the both of you a very happy new year. I hope you had a stellar start to this year, the year 2026.
Yes, indeed. And a very happy new year to both of you, Shibani and Somira.
Okay, my first question to you, Mr. Bandopadhyay.
But sir, not such good news coming at the beginning of 2026.
Yes. All right, my first question to you, Mr. Bandopadhyay, is that 2025, saw, as we discussed, the billionaire club shrink, sizably this year. The wealth erode, FIIs also took flight. Can domestic earnings alone, according to you, realistically drive like a promising 2026? If you can give us like the feelers right at the start of the year, what does it look like going forward?
Well, definitely the domestic earnings are looking good. In fact, you all will recollect that second quarter, most of the analysts were very pessimistic about the numbers, but the numbers by and large came much better than what was being expected. And expectations are that Q3 and Q3, which we have just ended, and Q4, which we have just begun, should be much, much better even compared to Q2. Obviously, the government's GST rationalization has played a role. The income tax relief, which the government had announced in the last year's budget, is going to play a role over the festive and this winter season. There is a talk of pay commission grants being released. Revision, which the pay commission has recommended being released, that also will play a role. So by and large, I think the consumption demand, which was anemic, has picked up, and that definitely will do wonders as far as corporate earnings are concerned. And Q3, Q4 will be much better compared to Q2, and even, of course, Q1. Q1 was really bad. So corporate earnings will improve. But having said that, I must mention a bit about the foreign investors. They have been continuously selling in Indian markets, as you guys have rightly pointed out. And at some stage, we will expect the selling to stop, and they should come back to Indian markets. Sustainable rally in Indian market, to my mind, will be possible when the FIIs starts coming back and buying back into Indian equities. They haven't been doing that. And in spite of so many good news, they haven't been doing that. Of course, valuation was a bit of a concern. India-US trade deal not happening was a concern from their point of view. The global geopolitical tension was a matter of concern because they had become to an extent risk averse. And India being, valuation-wise rich compared to other Asian peers also had an impact on their exit as well as non-participation in Indian markets. So to my mind, corporate results improving as far as domestic factors are concerned will help the cause. But the real bump up, real upward movement will come when the FIIs start buying into Indian markets in 2026.
Right. Right. Right, Mr. Bandopadhyay, thank you very much for setting the context for all our viewers and, of course, for all of us as well. Let me take the point across to Mr. Subramanian. Mr. Subramanian, would you agree with what Mr. Bandopadhyay is essentially suggesting, that 2026 looks much better, Q4 is going to be better as well? However, the points and the factors that he's mentioned, the FII outflow, because of course, a rupee contraction that's happened on account of global macroeconomic factors, of course, these wars are also raging. Do you think these are going to get settled in Q4? Are you of the same view as well, and do you hold the same optimism?
I do broadly agree with Sudeep ji here, and I do hold the same optimism. And I would like to expand on what he said with 2-3 points. So first is the turnaround is already there. Now, if you look at the fact that the worst performing sectors for the year were IT, realty, and consumer durable. Now, if you take the same three sectors for the last 3 months, IT has given double-digit returns, realty has turned positive, and consumer durables is about 1% negative. So there's already a shift in terms of the fact that the most underperforming sectors have started recovering right from the October, November, December quarter. The second aspect here is that I think that even if an FII selling comes down, I think the markets will regain their momentum. The buying comes, obviously, it's wonderful. But even if the selling comes down, because the way I'm saying this is, DIIs bought about 8 lakh crores last year. FIIs sold only about net, I think 1.5 lakh crores if you take off net of the primary market investments they made. So it was 3 lakhs gross in sales in terms of secondary market sales, and 1.5 lakh, 1.6 lakh if you take a primary market and net it off. So the balance, you see, the shift is because the DIIs have chosen sectors to invest in, and they've chosen banking because the best performing sector was PSU, banks and capital markets and private sector banks and all of that, right? But the fact that the FIs have been selling has made them buy larger cap stocks. And that's why you've seen the return differential between large and small. So if FIs selling comes down itself, you'll find that DIIs will now go chasing growth. And I do think that the earnings growth coming through this year is a very strong probability, for the simple reason that all the efforts taken both on the fiscal and monetary policy, income tax cuts, GST cuts, RBI rate cuts, liquidity infusion, CRR cuts, bank reforms, all of these will have a full year to play out. And I do expect definitely that from an earnings perspective, you'll have a much better 2026 compared to that. And when these are domestic factors driving the play, automatically you will see mid and small cap earnings also gather pace. And DIIs will then allocate to those sectors. As long as FIs are not ruthlessly selling and giving them large caps at a cheap price, I think DIIs will make the right choices from a 3 to 5 year. Because remember one thing, DIIs have a 3 to 5 year perspective. Mutual funds take the money for 3 to 5 years. So they are not looking at the immediate valuation, they are looking at the growth factor. So if there's a sign of earnings recovery, they will shift their allocation to mid and small cap, and the broader market should rise. And
absolutely. Given your prediction that the mid and small caps will outperform the large caps in 2026 after a disappointing 2025, which domestic sectors besides what you mentioned in your previous answer to my colleague, besides IT and real estate, are you most optimistic about, Sunil Subramanian, going forward?
Take a year and a half perspective, I think it's consumer durables, because we saw only auto within the consumption pick up the GST cut momentum. But consumer durables didn't, and a large part of that is because cooling related air conditioners, refrigerators will pick up only in the summer. The second is the realty sector is also a key beneficiary of the GST cuts. But because there's been a supply shortage of affordable homes, this year developers will create more supply there, and the real estate should pick up. So consumer discretionary is, I think, the strongest from a year and a half outlook. But if you have a slightly longer 3 to 3.5 year outlook, you can see that the GST cut is going to lead to very good sales. What happens at margins is a different question. But because of the sales, capacity utilization in the country will go up. And I expect us to touch that Rubicon 80% capacity utilization during the year. And private capex will be the new story for the next 3 to 5 years. And that's also heavily mid and small cap driven. So to me, discretionary consumption and capital expenditure, capital goods cycle are the two other domestic sectors we should focus on.
Right. Very interestingly, you mentioned about private capex, and that is something that remains to be seen, given the fact that government capex has, of course, been only getting accelerated over the past couple of years. But Mr. Subramanian, you also pointed out to the IT sector, but of course, there seems some concern as far as the IT sector is concerned on account of what the United States is essentially going to do with respect to the higher policy. But let me shift tracks a little bit and go back to Mr. Bandopadhyay. Mr. Bandopadhyay, when we talk about the shrinkage of wealth of billionaires, how do you explain that shrinkage? Because of the fact that the long-term growth narrative of India, along with robust GDP performance, these two factors have been kept intact. So what really sort of explains this contradictory view that's coming in on account of the shrinkage of wealth of billionaires, and what does this essentially point to?
Well, Sumita, I would say that if you take a particular time span and do these calculations, there will be volatility. I don't think there's anything to get perturbed about the shrinkage in number of billionaires during last calendar year. Yes, the certain billionaires have lost because the overall performance in the market hasn't been good and the share prices have come down. So naturally, their wealth has come down. But I don't think we need to be perturbed. It's a matter of time before things pick up and we get to see these billionaires' wealth also going up and new guys joining the billionaires club. So I don't think I will read too much into it. We were talking about real estate. Some real estate companies have gained during the last calendar year in a big way, and some real estate companies haven't gained that much. So obviously, there has been some volatility in the wealth of the owners there. The vaccine manufacturers, there was a lot of excitement during the COVID period, and there was an euphoria, you can say generally, in terms of their valuation. And obviously, that euphoria is not there post-COVID when things have settled down. So probably the wealth there has come down to an extent. But again, in a with a long-term view, I think things will go back and improve only from here on. So I won't read too much into it. You will definitely get to see many more individuals, many more promoters getting added to the billionaires list over the period of next 3 to 5 years. There's absolutely no doubt about that. India is the fastest growing large economy in the world by far.
Yeah.
And this definitely will add to the billionaires list.
Absolutely. And in fact, just about a month ago, there was a story, Mr. Bandopadhyay, on the fact that many new age millionaires and billionaires, as you mentioned, have entered this elite list, and making it to the top when it comes to earnings and when their annual earnings and all of that. But having said that, let me just put this question across to you, Mr. Sunil Subramanian, that if you see, there is a huge divergence in terms of, at one end, we are speaking about the billionaires' wealth eroding, like, someone like Shiv Nadar or even KP Singh for that matter. But at the other end, the likes of Ambanis are going up the ladder when it comes to this billionaire rich list. So why is that happening? Why there is so much of difference that, and across, across the list, if you see, there is a huge difference between certain billionaires just becoming richer and then the wealth of certain billionaires simply eroding.
Well, I think the answer lies in the fact that what is reported as the billionaire's wealth is largely public market wealth. And so when you then look at the public markets, we know that the IT sector had a bad year. We know the realty sector had a bad year. So Mr. Shiv Nadar, because HCL represents a big portion of his wealth, naturally the erosion in HCL share price affected it. Similarly with Mr. KP Singh and DLF. The second part is that a lot of promoter offers for sale were there this year. So they took money off the public markets and they invested it in the private markets, which is not exactly computed in a professional way to account for the wealth. So the investments they made with the money that they booked from their offer for sale also does not get accounted in the right way. So I think that it's just this. Next year, when the markets bounce back, you'll see the same billionaires, we'll have the same show next year, same time, saying, oh, billionaire wealth has grown so rapidly this year. What's the cause for it? So I'm sure that it's just a matter of the stock market reflecting, because their primary wealth is in the companies they own, which are in those sectors which got hurt this year, because the performance of the large caps and the mid cap, which is the two indices which delivered positive returns, has been driven by the banking and financial services sector. And none of these people are owners of a bank or any financial services company, because that's the sector which has driven the market up this year. So I think the absence from the fastest growing segment of the market and their presence in what hurt the market is just a way this whole calculation has been done. I'm sure that none of them feels disheartened about this, because they probably have been reinvesting in their companies at this time of the correction.
Right, sir. And in fact, let me take that point across to Mr. Bandopadhyay. Mr. Bandopadhyay, would you agree with Mr. Subramanian, and would you also say the fact that perhaps the concentration of wealth is not the core story here? Because essentially what we are seeing, if you look at the data, well, Mukesh Ambani, Gautam Adani, their net worth has in fact increased, and of course of the likes of Sajjan Jindal, Amrita Vakil and others, but of several others it has decreased. So is it not about concentration of wealth, in fact further concentration of wealth?
Not at all. I think I completely agree with Sunilji. Look, again, I would repeat that we are looking at a particular period of time, and we are looking at listed share prices. Certain segments, certain sectors did well. So people having listed shares in those segments, obviously their net worth increased. And, certain sectors didn't do that much well. The IT is a case in point. So all the IT promoters' wealth came down. Shiv Nadar's wealth came down. So I think, I don't think we can, get to conclusions based on these. Of course, I mean, if you really get to the detail, definitely Mr. Ambani, Mukesh Ambani, as well as Mr. Gautam Adani, they have been very successful in multiple sectors they operate in, and I'm sure their wealth has gone up significantly. Some of the sectors which they are involved in also have done very well, so naturally their wealth has gone up, and they're by and large diversified, as opposed to some of the IT promoters and real estate promoters who are very focused and have investments only in the particular segment they are working in. So obviously, if the segment doesn't do well, their wealth comes down. But as Sunilji mentioned, and I will reiterate that, this is only a matter of time. Next year, you find some certain other segments of the market doing well, and the related promoters' wealth coming up. So yeah, these numbers will keep moving up and down. I don't think anybody is becoming disheartened by seeing his or her name in the list or out of the list. Also, I must confirm what Sunilji said. A lot of offer for sales came. So people, I mean, may not be the individuals we are talking about here, but they took money out from public market through offer for sale, and that money came back in a private market. And that is definitely not properly being accounted for while we calculate these billionaires list.
Mr. Bandopadhyay, considering Nifty reached a 10.5% gain despite small cap and mid cap underperforming, what specific policy measure or government reform would act as the biggest trigger to shift the market from this selective range-bound performance to like a broader market rally going forward in 2026?
A couple of things I must mention here. I don't think it's for the government to do. They have been doing a lot of things. Of course, the budget can give some relief in terms of rationalization of STT, rationalization of capital gains tax, because these have been, niggling worries and niggling problems for the market, particularly the capital gains tax, which significantly erodes the return which an investor gets from the market. And this have been bugging the foreign investors because, they invest in multiple markets, and, most of the markets don't have these irritants. So, when you are investing in India, you have all these, taxes which kind of complicate the return which they get and reduce the return. Why complicate? Apart from complicating, they actually reduce the return. So they are definitely affected by that. So some rationalization by the government in terms of in the area of STT as well as capital gains tax definitely will help the cause of the equity capital markets and probably help FIIs return to India in a big way. Of course, as I mentioned earlier, FIIs return to India will also be linked to India-US trade deal. It's a psychological thing maybe from our point of view, but for FII point of view, I think it's psychologically important. They are also they also look at geopolitical scenarios and they look at valuation, of course. And our valuations, even now after time correction for over last 6-8 months, still continues to be richer compared to some other Southeast Asian neighbors and our competing capital markets. So they have to come back to Indian markets for Indian markets to go up. And government can, of course, do some rationalization in capital gains tax and STT to help the cause. But beyond that, I don't think there are too many things the government can do at this stage. It's for the corporates to perform, for the global markets and trade deal to happen. I think that will work the wonders. I'm not too perturbed between large cap, mid cap, small cap. Look, the market has to do well. Which segment, which sector will do well depends on multiple things. And it doesn't matter whether large cap does well or small cap or mid cap. Yes, retail investors flock generally more towards small cap. But overall, the market has to do well. Overall, economy has to do well. I think that's most important.
Absolutely, Mr. Bandopadhyay. So essentially, it all boils down to the fact that the FIIs are going to come back to emerging markets, and of course, India needs to be bracing for those kind of changes to happen, that movement to happen. Let me take in a word from you, Mr. Subramanian. What is it that you are asking from the finance minister this budget for those FIIs to come back, and of course, the markets to reach new highs?
So I think that for me, the single most important point, or maybe 2 points, would be that first is I'd like to see PSU bank mergers being put on top of the table, because I think funding is a critical need and our PSU banks are not yet global sized. So to the extent that then they can tap global capital, the fact that domestic deposit growth is not keeping pace with credit growth is a challenge for them. So they have to raise international capital at reasonably good rates. So I think that mergers of 2-3 good quality public sector banks is something which would give a huge boost to that whole segment and to the financing that is needs of the country, because now we don't have any project financing institutions any longer. So the PSU banks have to pick up the long-term lending. So that's number one. Number two is a greater involvement of the private sector in the capex program of even the government. So public-private partnerships where the PSUs can use their land banks as their equity and private sector comes in and creates that extra capacity creation along with the government-owned companies. And the PLI scheme probably needs to be tweaked and modeled, because we've only seen in electronic manufacturing and a few other sectors the PLI has succeeded. But the PLI has to become broad-based success if India has to become that manufacturing-oriented country away from a services dependence. So I think those are two key things which are the long-term growth drivers for our economy, which FIIs will look at. See, the taxation has been there as an issue. I don't think the government is in a position to take away long-term capital gains tax for FIIs, because with the GST cut, you're already going to be seeing, we have to key and see how the fiscal deficit shapes up. So I don't think they are in a position to give away any more revenues from that point of view. So while that's a nice to have, I'm not sure the government is going to be able to do that. So I think FIIs ultimately want to see a long-term growth trajectory for the country. And so multi-year cycle, because capex is a multiplier, plus of course the trade deal is very important. Little that the government can do because there are red lines at our end. And that's something that we just hope and pray will happen sometime during the year. But from the government side, I think already I pointed out that is the involvement of the private sector in the capital expenditure program in some form, which will be the multiplier for the economy. I have no doubts about that. And for that, consumption has to first pick up, capacity utilization has to pick up. So I think this government is already on the path. Probably in the budget, they will do a little more middle class related giveaways to boost the consumption.
Yeah, you mentioned very eloquently, in fact, what will make the FIIs make a comeback to the India market. But 2025 as a year saw tremendous pressure, Indian rupee facing tremendous pressure. And of course, what we discussed extensively, FIIs exiting the market. Mr. Bandopadhyay, in fact, made a very pertinent point on the India-US trade deal. How much is dependent on that? And can the India-US trade deal by itself alone stabilize the currency and also trigger FIIs come back to the India market?
So I would say that, there's a little bit of chicken and egg here. I know you mentioned some time back that the currency was caused by the, was, hurting the FI's return. But it's actually the FI pullout which has caused the currency to weaken. So it's they have been the cause of the currency weakening, and for them it proved to be a reinforcing philosophy because they pulled out, they didn't lose the currency part. So actually they saved themselves by pulling out in a time the currency was weakening. And why was the currency weakening? Because of the trade deal, and not directly, because the Reserve Bank of India, as a defensive measure against the 50% tariff, right, had to allow the rupee to weaken to help our exporters compete with our competing countries. So I think the trade deal ultimately is also the key factor, also driving FI flows and also making the currency weaken. So any signs of positive sign around the trade deal happening will help the currency to recover and FIs to come back. So it will be a self-fulfilling prophecy, because the moment FI comes back, dollar comes in, itself the currency will strengthen. And on top of it, the trade deal news comes in, RBI will no longer need to allow the rupee to depreciate, and they can allow it to strengthen a bit. So I think the trade deal is very important from that point of view, because it acts both in the RBI part as well as on the FII part.
Absolutely, Mr. Subramanian. It remains to be seen when that deal, or at least the package deal that gets announced. We're given to understand that Sergio Gore, the ambassador designate to India, he is going to be assuming office in January. And will Donald Trump give him an early win? That remains to be seen. But we have time for just one final question, Mr. Bandopadhyay, and I'll take that question to you. And coming back to the point of billionaire wealth erosion, would you say at the end of this discussion that it is not a sign of deeper economic signaling, given the fact that what we are seeing in terms of what's happening within the Indian economy, whether it's related to wages, etc., that remains a concern. So would you not say that this is a deeper economic signaling that's coming in from the story?
No, I won't say that. I think Indian economy is doing fine. Of course, there are at least one challenge which I believe needs to be addressed. But beyond that, things are at this stage doing pretty well. The only challenge, and I will say, is the negative. Some of the inflation components have become negative. Inflation has come down beyond an acceptable level, and this is not definitely good from a long-term perspective. It's always better to have an inflation around 3-4%, and that is the target which has been set by RBI, and we are much below that. Now, this scenario leads to a poor nominal GDP growth. Even if you have 7-8% of a real GDP growth, on top of that, the inflation is only 1-2%. Then you are still probably in a single-digit nominal GDP growth. That definitely doesn't augur well. And today we have a scenario where food inflation is probably becoming negative, and that does impact rural income in a big way. And again, we will get back to the same kind of a cycle where rural income coming down will lead to a problem in consumption, and problem in consumption will lead to lack of private capital expenditure, which Sunilji is explaining again and again. So I think we have to address this. The government, as well as RBI, so monetary and fiscal policy will have to work together to ensure that we have a healthy inflation in the economy. While, apparently sitting outside, people may get excited seeing that inflation has come down and, inflation is negative. But the economy needs an inflation, a certain level of inflation. And that is, to my mind, the only problem today, because that persisting beyond an acceptable period of time will lead to a lot of challenges in the real economy and will again lead to a slowdown in consumption, which is definitely not desirable.
All right. Thank you so much. We are just out of time, Mr. Bandopadhyay, and thank you so much for joining us. Also, Sunil, Subramanian, thanks again for joining us on ET Now.
Thank you.
Well, on that note, it is time for us to slip into a very short break, but there is a lot of news to follow on the other side of this break, so you don't go anywhere. We will be right back.